Over the past few years, we've seen some sweeping changes to state tax systems, many of which favor retirees. From new deductions and expanded property tax exemptions to full elimination of tax on Social Security, the landscape is shifting fast. And for retirees thinking about relocating or spending part of the year in another state, these changes aren't trivial. They can have real planning implications. In this video today, we're going to be covering 11 states that have made meaningful tax changes since 2023 and what they can mean for your retirement income. Now, when we talk about state tax implications, most people immediately think of state income tax. And it's true that states with low or no income tax often show up on some of the top most retiree-friendly lists. But focusing only on income tax is a narrow view. Every state needs to collect revenue somehow. And if they're not taxing income, they're usually making it up somewhere else through higher property taxes, sales tax, or other fees. That means the cheapest state for you may look very different than the cheapest state for someone else. For instance, if you're living in a high property tax state and have a lot of wealth tied up in your home, those annual property costs could easily outweigh any savings from lower income tax. The point is, retiree-friendly is highly personal. There's more nuance than a top 10 list can capture. Now, in this video today, we're not going to be breaking down every layer of every state's tax system. Instead, we're going to be focusing on something more targeted. 11 states that have recently made often quiet but meaningful changes in favor of retirees. Why does this matter? Well, first, you might already live in one of these states and might have missed some of these changes. Second, if you're considering relocation, one of these states may be on your short list, and these updates could maybe tip the scales. And then third, if you're someone with a second home or are considering one, these laws could impact where you choose to establish residency. Many states follow some version of the 183-day rule, meaning if you spend more than half of the year in a given state, you can claim tax residency here. Now, the rules vary state by state, and the details matter and can get quite complicated. But the point is, if you're willing to plan around it, you may have options, and those options could lead to some real tax savings. First, let's talk about 4 states that have made changes to how they tax Social Security benefits, or rather eliminating tax on Social Security benefits. At the start of the decade, there were 13 states that tax Social Security in some form or fashion. That number is now shrinking. In 2024, 3 Midwestern states, Missouri, Kansas, and Nebraska, fully eliminated their state tax on Social Security. These aren't generally low tax states either. Each of them have moderately high income tax rates. So removing the tax on Social Security represents a meaningful shift for retirees. Then we have West Virginia, which is taking a more phased approach. In 2024, 35% of Social Security benefits were exempt. 2025, that increases to 65% exempt. And then by 2026, Social Security income will be fully exempt from West Virginia state taxes. Next, we have Colorado, which has made a number of recent changes that benefit retirees. First, Colorado uses a flat income tax system, and in recent years, that flat tax has been gradually reduced. It's been steadily reduced from 4.4%, but there's an ongoing push to bring it down even further to as low as 4% if certain state revenue targets are met. Second, Colorado offers a retirement income deduction for residents age 55 and older. This includes income from things like pensions, IRA withdrawals, and 401ks. If you're over the age of 65, that deduction increases even further. And importantly, these are per person deductions. So if you're married and both spouses are over 65, you can deduct up to $48,000 in retirement income from your Colorado taxable income. On top of that, Colorado has made some improvements to how it handles Social Security taxation. If you're 65 or older, you can fully deduct any federally taxed Social Security benefits from your state return. No income limits apply. If you're between 55 and 64, you can also deduct federally taxed Social Security benefits, but only if your AGI falls within a certain range. Altogether, this means that if you're a retiree in Colorado, you can often keep a reasonable amount of income completely untaxed at the state level, especially if you're living primarily on Social Security as well as moderate IRA or pension income. And then anything above those deduction thresholds, it's still only taxed at that flat rate in that low 4% range, making Colorado one of the more moderate and predictable tax environments for retirees. The next state making massive retirement tax changes is the Great Lakes state, Michigan. Since 2023, with the passing of the Lowering Michigan Cost Plan, Michigan has been steadily increasing its retirement income deduction, and the changes are quite substantial. Now, when we talk about quote unquote retirement income in this context, we're referring to withdrawals or income streams from qualified accounts. That includes things like private or public pensions. That includes things like IRA withdrawals. That includes qualified annuity payments. Basically, anything that shows up on your 1099-R is likely to qualify. This plan phases in gradually. In 2025, retirees can deduct 75% of what will be the maximum amount, which works out to roughly $50,000 for single filers and double that for joint filers. By 2026, the full deduction kicks in, increasing to over $65,000 for individuals and more than $130,000 for joint filers. And those caps are indexed to inflation. Eligibility is also expanding. You no longer have to wait until age 67. Beginning in 2026, anyone age 62 or older will qualify for the full deduction. Now, keep in mind, Michigan already doesn't tax Social Security. So let's say you're married, bringing in $50,000 in Social Security benefits. You could take another $130,000 from your IRAs or pensions, and you wouldn't owe a single penny in Michigan state income tax, assuming you're also not generating substantial taxable interest, dividends, or capital gains on top of that. By all accounts, this makes Michigan one of the most affordable states in the country, at least tax-wise, for retirees, especially those with a lot of traditional retirement income. Next up, we head to the heartland, Iowa, which recently made one of the most sweeping and straightforward retirement tax changes in the country. Starting back in 2023, Iowa fully exempts all retirement income for residents age 55 and older. This was part of a broader tax reform package designed to simplify the tax code and make Iowa more attractive for retirees. The key here is simplicity. There's no income cap, no deduction limit, and no complex phase-in. If you're age 55 or older and your income is from retirement sources, it's simply not taxed at the state level. On top of that, Iowa is also in the process of flattening and lowering its income rates across the board here too. Currently, the state has a flat tax of just 3.8%, down from the progressive rates that once topped 8.5%. So for retirees who do have other sources of income like interest, dividends, or part-time work, those earnings will be taxed at much lower rates. Bottom line, Iowa has gone from moderately tax-heavy state to surprisingly quite retiree-friendly very quickly. Now let's head to Mississippi, which is already one of the more tax-friendly states for retirees and somehow is still getting better. First, retirement income is already fully excluded from state income tax. This isn't new. Mississippi has had this exemption in place since the 1980s, making it one of the few states that never taxed retirement income to begin with. But the changes don't stop here. The state is in the process of lowering its flat income tax rate, going from 4.4% down to 4% in 2026, with a longer-term goal of phasing it down to 0%. Starting July 1st, 2025, the sales tax on groceries will also drop from 7% to 5%, which is one of the more meaningful ways to lower everyday costs of living, especially for fixed income households. And then we have the homestead exemption, already quite generous, but it's also expanding. Right now, Mississippi exempts the first $7,500 of assessed home value, which covers about $75,000 in market value from property taxes if you're over the age of 65. But in 2026, that exemption will jump to $12,500, effectively wiping out property tax on homes worth around $125,000 for retirees. So to recap, no tax on retirement income, a lower income tax rate is coming, cheaper groceries, and potentially zero property tax on your home. Mississippi was already a tax haven for retirees, and it's frankly only getting better. Now let's head to the New England region, which most states are known for higher taxes across the board, especially when it comes to income and estate taxes. Well, one state stands out, New Hampshire. Starting in 2025, New Hampshire will eliminate its tax on dividends and interest income, which have been the last major form of individual income tax still on the books. So as of this year, New Hampshire will have 0% state income tax, 0% sales tax, 0% estate or inheritance tax. That's a sharp contrast from its neighbors. For retirees living in or wanting to move near the Northeast, that means New Hampshire is effectively a regional tax haven. Finally, we move to two more states in the Midwest, and you've probably noticed by now that the Midwest is leading the charge when it comes to making retirement more affordable, again, at least from a tax standpoint. Starting in 2025, North Dakota will offer an increased property tax credit of $1,600 per household. What makes this unique is that there's no age requirement. This credit applies to all primary residents, meaning both for retirees and pre-retirees. Then we have my personal home state, Wisconsin, which has made a very direct retirement-friendly change starting in 2025. Tax filers age 67 and older can now exclude up to $24,000 for single filers or $48,000 for joint filers in retirement income from state taxation. And importantly, this new rule comes with no income restrictions, a big improvement over the previous system. In addition to this, Wisconsin is adjusting its tax brackets as well. The 4.4% bracket will now apply to a wider band of income before jumping up to 5.3%, which benefits retirees with moderate part-time earnings or taxable investments. And finally, Wisconsin is also eliminating sales tax on electricity, which is a nice quality of life benefit for anyone living on a fixed budget. For retirees who want to stay near family in Wisconsin, or maybe are snowbirds who don't spend enough time down south to qualify for some other state tax systems, this is another meaningful shift that may open the door to more flexible planning. Now, before we wrap up this video today, it's important to zoom out for a second and make sure we don't lose the plot with this type of video. The best state for you to retire in might not have anything to do with taxes at all. Yes, taxes certainly matter. And yes, we walked through 11 states making meaningful changes that can help you keep more of what you've already saved. But taxes are just one piece of a much bigger picture. The right place for you to retire depends on a combination of factors: the weather you enjoy, access to certain healthcare, how close you want to be to friends or family, the community you want to be a part of, recreational or lifestyle opportunities, and yes, of course, affordability and tax structure is a variable. But the takeaway here is simple. If you've already landed in the place you love and it supports the lifestyle that you want in retirement, that's incredible. But if you're open to relocating or establishing residency in a second home, or already have a second home in one of the states that we talked about, some of the tax changes that we just talked about might be worth working into your plan. Because a better retirement isn't just about saving more or chasing returns. It's about aligning your income, your values, and your lifestyle and building a plan that supports all three of those. I hope you enjoyed this video, and if you did, do me a favor and hit the subscribe button down below to get more content just like this every week. Thanks for watching, and always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.